Everyone says you gotta spend money to make money, but no one tells you where to get the money when you're just starting your business. So that's what we'll do today. I'm Corinne, a small business expert at NerdWallet, and I'm going to break down 8 of the most common ways to fund your startup so that you can figure out which one's best for you. 1. Bootstrapping, which usually makes me think of those tall pirate boots with the big buckles around the knees, but actually it just means using your own money. So think personal savings or retirement funds to start your business. And it's surprisingly common. Nearly 2/3 of new businesses rely on personal savings or family savings to help get the business up and running. The biggest pro of bootstrapping is that you stay in full control of your company, so there are no loans, no interest payments, and no investors. The con, if your business fails, you could lose your savings, which is a big risk to take. Bootstrapping is best for freelancers, contractors, and online sellers, as well as anyone with strong personal savings who wants to maintain control of their business. 2. Friends and family. If you're lucky enough to have a supportive network of friends and family, then you may be able to get startup funding from them, either as a loan or an investment. If it's a loan, you'll be expected to repay the borrowed funds. If it's an investment, then you'll give up partial ownership of your business and potentially share future profits. The benefits are quick access to flexible funds with no lengthy application process and no credit check. The drawback is probably what you would imagine. Taking money from friends and family can put your personal relationships at risk. So we recommend putting your loan or investment terms in writing and setting clear expectations for both parties. This option is best, of course, for those with a supportive and trustworthy network. 3. Business credit cards. Business credit cards work just like personal credit cards, except you use them for business expenses. They are easier to qualify for than business loans since eligibility is based solely on your personal credit, not your time in business or annual revenue. Plus, you can earn rewards like cashback or points for each dollar you spend. However, if you carry a balance on your card, then interest costs can add up quickly. These cards also tend to have lower credit limits than personal credit cards, so they're not a great option for large purchases. A business credit card is best for covering day-to-day expenses and unexpected costs, especially when you need fast and flexible funding. 4. Personal business loans. These are offered by banks, credit unions, and online lenders. Unlike traditional business loans, eligibility for these loans is based solely on personal credit and finances, which can be especially helpful for a new business. There are a few benefits of personal business loans. They are fast to fund, easy to apply for, and you don't need business history or revenue to qualify. The drawbacks are smaller funding amounts and shorter repayment terms than standard business loans. And if you can't repay the loan, then your personal credit and assets are on the line. Personal business loans are best for entrepreneurs with strong personal credit. 5. Microloans. Microloans are small dollar loans, usually $50,000 or less, offered by nonprofit or community lenders. They're often easier to qualify for, especially if you're a new or traditionally underserved business. Many microlenders also offer business support or education in addition to funding. If you need a large amount of funding, though, microloans likely aren't the best option. And in most cases, your business must already be operational in order to qualify. Microloans are a particularly good option for women, minority groups, veterans, and entrepreneurs located in low-income communities. 6. Online business loans. Online loans are issued by alternative lenders, so non-bank lenders like fintech companies. They're known for their speed and convenience. They offer faster approvals, less paperwork, and more flexible requirements. Plus, these lenders often don't require years of business history or physical collateral. But there is a trade-off for the speed and flexibility of online loans. Many of them have high rates and fees. These loans are best for startups that need funding fast and may not qualify for traditional bank loans. 7. Crowdfunding. Crowdfunding allows you to raise money through online campaigns or social networks. In exchange for donations, you can offer rewards like early access or free products, or give up equity in your business, depending on the type of campaign. On the upside, you can raise money and build excitement around your business. Plus, funds don't need to be repaid. On the downside, How much money you raise largely depends on your network and how well you market your campaign. Most crowdfunding websites also charge you fees to use their platform. Crowdfunding is best for product-based businesses with a strong social media presence and marketing skills. 8. Small business grants. Grants provide free money for your small business. They're available from federal and state agencies as well as private companies and organizations. The biggest pros of a grant are that you don't need to repay the funding, pay interest, or give up ownership in your business. They are highly competitive, though, and applications are quite time-consuming. A grant is best for mission-driven startups, businesses in niche industries, or underrepresented entrepreneurs who meet specific eligibility requirements. Every startup needs funding, but the right solution depends on your goals, how much capital you need, and your current finances. For more information on startup funding options or to apply for a loan through our marketplace, visit nerdwallet.com. And if you found this video helpful, hit like and subscribe.